auditors and controllers work, we want to show you an overview of indeed that playing field, and at the same time introduce you to the key roles in this financial system that we created. Now, let's take as a starting point an organization. Well, this organization has a supervisory board and an executive board, and let's zoom in right at the executive board at the role of the CFO, so the Chief Financial Officer, or sometimes it's called a director or financial director or a manager. This person is responsible for goal setting, for direction of the firm, for incentive systems maybe within the organization, and he or she needs to have information to base these decisions on. Now, you can imagine that there's a lot of information out there, and then the question is, of course, how to make sure you have the right information to make the decision. So there might be information on sales, but there might also be information on how well a firm is operating in terms of non-financial performance, maybe CO2 emissions or social performance, so to speak, social impact of a firm. And then, of course, to make sense of all that information, there is often a controller within organizations who reports and analyzes all this sort of information. Not only internally, so he or she will give that information to a CFO or a manager, but also externally. Because also outside of the organization, there's a lot of people interested in what happens at a firm. So there's, of course, the shareholders, the owners of the firm, who want to know how are things going. And there's, of course, a bank who wants to know how well is this firm operating, to which I lended some money. There's, of course, tax authorities who want to know how much money did you make and how much tax do you have to pay. There's also suppliers who want to know, how well is the firm doing and how dependent are we from you and how vulnerable is your firm for shocks in the market. And of course, also as customers, we want to know how well a firm is doing or what a firm is doing. Is it doing well or is it not doing so well? Is it what does it stand for, and so forth and so on. There's a lot of external users, and they want to have information from that firm. Now, but the question is, of course, how can we rely on information from that firm? Now, this is where auditors come in. Auditors are the ones who can check whether a firm is reporting indeed the right information. They do so by providing some level of assurance and say, the report that you now have, the annual report, for instance, that's going to the shareholders, contains information that is reliable, or we found no evidence that it's not reliable. So this is what an auditor does. So basically what an auditor does, an external auditor, is to provide some level of assurance to the information that is communicated by a firm. And of course this is financial information, but also increasingly this is non-financial information. We will come to talk about this later. Now, of course there's also a regulator who makes sure that a firm operates within the boundaries of the law and complies with the relevant laws and regulations. And this regulator not only checks the firm, but also checks whether what the auditor has checked indeed is good, whether the audits performed by an external auditor are of sufficient quality. So in the Netherlands, this is the AFM, the Authority for the Financial Markets. That's the regulator. So in this overview you see, most of the key players. We identified 5 roles. So there's the CFO or manager, there's the controller within the firm, then there's the regulator, there's the external auditor, and of course in the end there's the external users, which can be many, also more than appear on this slide. These 5 roles all have a distinct perspective on accounting. These 5 roles are central during this course. So each one of these 5 has a different perspective on accounting and control, but also developments such as digitalization and sustainability reporting have different implications for all 5. So they will all be affected by those developments somehow. We'll come back to that many times during this course. So I hope that during the different topics that we discuss, we will see how this impacts these different roles. Now, let's talk you through all these individual roles in some more detail. So let's start with the controller. And I'm going to rely on chapter 16 in the Merchant van der Stede textbook, which is also required reading. And of course, one of the roles that a controller has is to report, both internally and externally, but also to help set up internal control systems to make sure that people cannot adjust their own salary, for instance, or record keeping to make sure that the assets of the firm are well recorded. Now, you can think of controllers as being centralized or decentralized, so you can have controllers at the corporate level, but also at business unit levels. I'll show you later on a graphic that makes this clear. There's these differences between different types of controllers. Now, one thing they can do is to develop internal control systems, also to make sure that the information that is provided, for instance, to a CFO to base decision on, is indeed accurate, that's verifiable, that's objective and true. But also they are the ones responsible for external reporting. So maybe reporting to tax authorities, but also to creditors who also want to know how well the firm is doing. So that's the controller. Now, then go to the chief financial officer. So this is a member of the executive board. And the responsibilities of this person include treasury, which is the raising and managing of capital of the firm, so how to make sure that you have the money to finance your assets. He or she is responsible for internal control within the companies to make sure that all the systems are in place, to make sure that the right numbers are reported and that the right actions are taken. He or she is also responsible for external reporting, so in a way this is like the supervisor, you could say, of the controller, and also responsible for the incentive systems that are developed within the organization. So this is also something that will come back later. So how to incentivize people within the organization. Now there's also the external auditor. I stress here external because there's also internal auditors. We'll talk about those later as well. So the external auditor is independent, and of course internationally we have the big four firms, that's EY, PwC, KPMG and Deloitte, and they are independent auditors and they provide assurance when it comes to financial but also non-financial data or information, such as emissions, but also how well is a company doing in social terms. So what is the board or gender diversity in senior positions? And what they do is they provide some level of assurance related to the information that's reported. So you could say they add trust to that reported information so that it's more trustworthy, the information that is reported by a firm. That's the external auditor. So there's a lot of external uses, more than are included on this slide, but let's look at a few of them. So there's, for instance, the creditors. Creditors are organizations that lend money to a firm. So you can think of banks. And of course they want to know how well the organization is doing, because based on that they might decide whether or not to lend more money to that organization or not. So they might want to assess based on annual statements of earlier years whether a company is credit worthy. So there's also the tax authorities who want to know how much money is being made and therefore how much tax has to be paid. There's the shareholders who want to know, well, do I get a good return on my investment? So what's the earnings per share? There's the capital markets, maybe future investors who want to know how well is this company doing and should I invest in it at some point or not? And they use all sorts of information reported by the firm to make the decision. But of course there's also the general public or sometimes NGOs, non-governmental organizations such as Greenpeace, who want to use information reported by a firm, maybe related to the climate impact they have, to make decisions or to criticize them perhaps in public or to pressure them to alter their practices. Last, there's the regulator. and the regulator makes sure that both the firms and the auditors are complying with the relevant regulation. So they might, for instance, focus on the firm's reporting quality. So do they report well in line with what is expected from them based on different frameworks? And the quality of the audit is checked as well. So are the auditors doing their jobs well? In the Netherlands, this is the Authority for the Financial Markets, the AFM, and the PCAOB is that for audits of firms that are listed in the US. We'll come back to that later. Now, this was the general playing field, but now let's zoom in on the company as a whole. So let's zoom in on one particular company, and then we'll see that more roles will pop up. As you can see, the picture of the organization is a little bit larger, so more people fit in the building now. So within the organization, you can say there's a supervisory board who oversees management, and they appoint an executive board. And we already met the chief financial officer, who's one of the persons within that executive board. Of course, there's also the CEO, the chief executive officer, and here's the chief financial officer, but there might be a chief operating officer as well, or a chief information officer is a role you see nowadays more often. So those are there. And there's also the staff, and within the staff there's different roles. So you can have a concern controller and also an internal auditor. And the concern controller is the central control function, who also sometimes manages all the other controllers at the different business units. And the internal auditor actually does something similar to the external auditor, but then within the firm. So they also assess internal controls, make sure that what is reported is true, objective, verifiable, and they also check whether these systems that are in place are of good quality, whether the firm complies with relevant frameworks. So those are the staff people that are relevant for us in this course. Now, you can say a firm has different business units, and let's focus on one business unit A. Of course, a lot of people work there, but some roles that are important for us are the business unit manager. This is the person that manages a division, but then also, of course, a business unit controller. So remember from an earlier slide that the controller makes sense of all that information, collects the information, or reports it internally. Here, he or she reports this internally to this business unit manager that then can make decisions based on that information. So, and of course, there's still the external auditor who goes through the whole firm to provide assurance on what is reported when it goes to external users. Now, in the prior slide, we could see that there's different types of controllers. Some are located at the headquarters, some are located at the business unit. And so you could say those at the headquarters you could call the corporate controllers or the concern controllers, and those at business units you could call business unit controllers. So given that controllers have different functions, it matters a bit where they are in terms of what sort of roles they have. So you could imagine that a controller at a business unit has more a role of supporting the business unit, whereas a controller at the central level, so at the headquarters, is more controlling, so to speak. And where you are in the hierarchy of an organization also really matters for how you probably carry out your role. Now, the book that we use by Merchant van der Stede in chapter 16 also identifies different structures for organizing the control function in firms. They make a distinction between the dotted line relationship and the solid line relationship. That's this one. So in A, there's the concern or the corporate controller, and there's a business unit controller, and here's the business unit manager. So I removed some other roles here. But here, the main relation is with the business unit manager. And if this is the case, if this is a solid line, you could say, then the business unit manager determines the tasks, priorities, and the evaluation of this controller. And then probably the business unit controller is more likely to support him or her in the decisions that have to be made. While in B, in a solid line relationship between the concern controller and the business unit controller, this business unit controller reports directly to the concern controller, and could carry out more roles such as a policeman to make sure that the business unit complies indeed with the relevant rules, maybe by headquarters, or the relevant rules and regulations by external organizations. So there's a difference here between the dotted line relationship, and the solid line relationship between the concern controller and the business unit controller. So read more about that in chapter 16 of Merchant and Van der Stede. This is it for now.